If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Chapter 1: The Foundation: Understanding the Profit Problem. Part 1: Why Traditional Accounting Fails Entrepreneurs. Why does every entrepreneur who talks about killing it in sales end up broke 3 months later? The traditional accounting formula treats profit like leftovers at Thanksgiving dinner. Sales minus expenses equals profit, which sounds logical until you realize it makes profit an afterthought. This formula assumes entrepreneurs will naturally leave money on the table after covering all their expenses. But here's the harsh reality: that leftover money rarely materializes. Consider the story of restaurant chain expansion that plagued companies like Quiznos. They grew from 200 locations to over 5,000 stores in less than a decade, celebrating massive revenue growth. Yet this rapid expansion created enormous infrastructure costs, franchise support expenses, and operational complexity. The more locations they opened, the more cash they consumed. By 2014, Quiznos filed for bankruptcy despite generating hundreds of millions in revenue at their peak. This survival trap catches most entrepreneurs. When cash gets tight, the instinctive response is chasing more sales. Need to cover payroll? Land another big client. Struggling with rent? Push harder for revenue growth. This creates what business experts call a cash-eating monster that grows hungrier with each feeding. The human brain cannot resist spending visible money. When entrepreneurs see $50,000 in their checking account, they mentally allocate every penny to urgent needs. Marketing campaigns, new equipment, additional staff, better office space. The money disappears before profit ever gets considered. Amazon provides a counterintuitive example. During their early years, investors criticized Jeff Bezos for prioritizing long-term profitability over explosive growth. While competitors burned through cash pursuing market share, Amazon built sustainable systems. When the dot-com crash eliminated their cash-burning rivals, Amazon emerged stronger because they never forgot that revenue without profit is just expensive busywork. Traditional accounting fails because it ignores basic human psychology. Entrepreneurs are optimists who believe the next sale will solve current problems. They confuse activity with achievement, mistaking busy bank accounts for business health. The formula sales minus expenses equals profit assumes perfect self-control that no entrepreneur possesses. Most businesses cannot grow their way out of profit problems. Growth typically increases complexity faster than it increases margins. More customers mean more support needs, larger facilities, additional staff, and expanded inventory. Revenue growth without profit discipline creates beautiful-looking companies that collapse under their own weight. The perfect company size emerges naturally when you prioritize profitability over growth, not the other way around. Part 2: The Behavioral Psychology of Money. Your brain tricks you into terrible financial decisions every single day. Money sits in your business checking account, and your mind instantly begins planning how to spend it. Cyril Northcote Parkinson discovered something profound in 1955 while studying British government bureaucracy. Work expands to fill the time available for its completion. But this principle applies far beyond office productivity. Money behaves exactly the same way. Expenses expand to consume whatever revenue exists in your bank account. Think about your last restaurant experience. At a traditional buffet, you load your plate with mountains of food because abundance surrounds you. Most gets wasted. Now imagine ordering tapas instead. Small plates force you to make deliberate choices. You taste more flavors with less waste. Your business bank account operates like that buffet. Large balances encourage large spending. Reed Hastings learned this lesson the hard way at Netflix. In the early 2000s, whenever cash accumulated, the company immediately found ways to spend it on new initiatives. Growth masked the underlying spending problem until the 2008 recession forced radical constraints. Those constraints led to streaming innovation and eventual market dominance. The human brain processes information through something psychologists call the primacy effect. First impressions create lasting influence over subsequent decisions. When you check your bank balance before making business decisions, that number becomes your spending ceiling. Your mind automatically calculates what you can afford based on what you see. This explains why entrepreneurs with iframe tags in their code often struggle with cash flow despite strong sales. They see money and immediately justify expenses. Marketing campaigns, new equipment, additional staff, upgraded software. Logic says these investments will generate returns. Psychology says, spend what you have. Dave Ramsey proved this principle with personal finance through his envelope method. Physical separation creates mental barriers. When cash exists in separate envelopes, labeled for specific purposes, people spend less overall. They cannot accidentally overspend in one category because the money simply does not exist there. Your business needs identical protection from your own spending impulses. Profit must disappear from your main operating account immediately. Out of sight truly means out of mind. When profit money sits in a completely different bank, preferably one requiring extra steps to access, your brain cannot factor it into daily spending decisions. This approach feels backwards because traditional accounting treats profit as whatever remains after expenses. But human psychology does not follow accounting logic. You need systems that work with your brain's natural tendencies rather than against them. Part 3. The Profit First Formula Revolution. The accounting equation you learned in business school contains a fatal flaw that destroys entrepreneurial dreams. Traditional accounting follows a simple formula: sales minus expenses equals profit. This formula treats profit like leftovers from dinner. Whatever remains after paying bills becomes your reward. But here lies the problem. When profit comes last, it rarely comes at all. Most entrepreneurs live this reality daily. They work exhausting hours, generate impressive sales numbers, yet struggle to pay themselves consistently. The bank account fluctuates wildly, despite growing revenue. This happens because human behavior does not follow mathematical logic. Consider how Netflix CEO Reed Hastings built his company. Instead of chasing maximum growth and hoping for profit later, Netflix allocated resources for profitability from day one. They constrained their content budget and operated within strict limits. This forced innovation in recommendation algorithms and user experience, rather than expensive content acquisition wars. The profit-first system flips this equation completely. Sales minus profit equals expenses. Mathematically identical, behaviorally revolutionary. This small change transforms profit from an accident into an intentional act. Every dollar that enters your business immediately separates into predetermined allocations before any expenses get paid. This approach mirrors how successful individuals manage personal finances. Wealthy people pay themselves first, through automatic investments, then live on what remains. They never rely on leftover money for wealth building because leftovers disappear into daily spending. When you allocate profit first, something magical happens. Your business must operate within the remaining expense budget. This constraint forces creativity and efficiency that abundance never produces. Netflix discovered this principle when they had limited resources compared to HBO or traditional studios. Constraints bred innovation. The mantra becomes clear. Revenue is vanity, profit is sanity, cash is king. Revenue impresses at networking events, but profit pays your mortgage. Cash in the bank determines whether you sleep peacefully or wake up stressed about payroll. This system functions as cash management, not traditional accounting. It forces your business to operate on current reality rather than future promises. No more justifying expenses because sales will cover it next month. You spend only what exists today after profit allocation. Amazon's Jeff Bezos operated this way during the company's early years. Despite massive revenue growth, he obsessively controlled expenses and maintained cash reserves. This discipline allowed Amazon to survive the dot-com crash when profit-ignoring competitors disappeared. The beauty lies in simplicity. Every transaction becomes a profit event rather than a rare quarterly occurrence. Profit transforms from something you hope for into something you expect. Your business adapts to this new reality faster than you imagined possible. Part 4. Parkinson's Law and the Small Plates Principle. Your business account balance acts like a plate at a dinner party. Put a mountain of food on a massive platter, and people pile on more. Serve the same meal on smaller plates, and portions shrink automatically without anyone feeling deprived. This phenomenon explains why entrepreneurs with fat bank accounts spend every dollar they see. Your mind treats available money like space on a plate. The bigger the balance, the bigger your spending appetite grows. Michalowicz calls this the small plates principle, and it transforms how businesses handle cash flow. Parkinson's law states that work expands to fill available time. Money follows the same rule. Expenses expand to consume whatever cash sits in your operating account. Reed Hastings proved this at Netflix during their transition from DVDs to streaming. Despite massive revenue, the company maintained strict spending constraints that forced creative solutions and efficient operations. Starting with tiny profit allocations removes every excuse for avoiding the system. Transfer just 1% of each deposit to a separate profit account. This creates barely noticeable constraints while proving your business can function with slightly less available cash. Most entrepreneurs resist because 1% feels meaningless. That resistance reveals exactly why it works. The magic happens through incremental confidence building. Success with 1% makes 2% feel achievable. 2% success makes 5% possible. Each step proves your business operates more efficiently than you believed. This creates what Michalowicz terms wealth of confidence, the growing belief that your company can thrive within tighter constraints. Higher profit allocations force operational creativity. When your operating account shrinks, you question every expense. Do we really need that subscription service? Can we negotiate better vendor terms? Should we automate this process instead of hiring? Constraints become catalysts for innovation. Toyota mastered this approach through their just-in-time manufacturing system. By maintaining minimal inventory, they forced suppliers to deliver exactly what they needed when they needed it. This constraint eliminated waste and improved quality while reducing costs. The system works because it accounts for human psychology rather than fighting it. Willpower fails when facing daily spending decisions. Systems succeed by removing the decision entirely. When profit money lives in a separate account, you cannot accidentally spend it on operations. Sustainable behavior change requires making the right choice the easy choice. Profit first creates artificial scarcity that feels natural while building genuine wealth through incremental discipline. Chapter 2. The System. Building Your Profit First Architecture, Part 1. The 5 Core Accounts Strategy. Michalowicz designed his system around 5 distinct checking accounts, each serving a specific financial purpose. Think of this as adult envelope budgeting, but with laser precision for business operations. Instead of stuffing cash into paper envelopes labeled groceries or rent, you're directing business deposits into separate bank accounts with clear boundaries. The income account acts as your financial distribution center. Every dollar your business earns lands here first. When Reed Construction in Denver implemented this system, their owner realized this single account change eliminated the confusion that had plagued their cash flow for years. Instead of money sitting in one massive pile where profit mixed with payroll and tax obligations, everything now had a designated destination. Your profit account becomes the vault for actual business profits. Most entrepreneurs assume profit equals whatever remains after paying bills. This backward thinking kills businesses. Netflix revolutionized entertainment by consistently allocating resources to content creation before covering other expenses. Your business deserves the same profit-first approach. The owner's compensation account ensures you actually pay yourself. Sarah Martinez ran a successful marketing agency for 5 years without drawing a consistent salary. She justified this sacrifice as reinvesting in growth. After separating owner compensation into its own account, she discovered her business could afford to pay her $60,000 annually while maintaining operations. Your tax account accumulates funds for quarterly and annual tax obligations. The IRS doesn't accept explanations about cash flow problems when taxes come due. This separate account eliminates the panic entrepreneurs feel when April arrives and they discover their tax money disappeared into operating expenses. The operating expenses account holds money for day-to-day business costs. Rent, utilities, supplies, marketing, everything except profit, owner pay, and taxes flows from this account. This physical separation forces brutal honesty about what your business can actually afford. These boundaries create instant financial visibility. When your operating expenses account shows $3,000, but your software subscription costs $5,000 monthly, you cannot ignore the math. The system prevents the dangerous game of moving money between purposes that destroys business profitability. Companies using this separation report feeling financially grounded for the first time. The anxiety of wondering whether money exists for various obligations disappears when each account serves its designated purpose. Part 2. Calculating your current and target allocation percentages. Most entrepreneurs make financial decisions while flying blind, operating with dangerous assumptions about their business health. Research from the U.S. Bureau of Labor Statistics reveals that 20% of small businesses fail within 2 years, with poor cash management as a leading cause. The instant assessment exposes your financial reality through simple math that most business owners avoid. This evaluation requires calculating what percentage of your real revenue currently flows to profit, owner compensation, taxes, and operating expenses. Real revenue represents your true baseline, total revenue minus material costs and subcontractor payments. A restaurant earning $100,000 monthly but spending $30,000 on food costs operates with $70,000 in real revenue for percentage calculations. Current allocation percentages reveal uncomfortable truths. Sarah Martinez, owner of a graphic design firm, discovered she allocated 0% to profit and owner compensation while dedicating 95% to operating expenses. Her $180,000 annual revenue generated no profit and no salary for herself. This pattern affects 83% of small business owners, according to Michalowicz's research across thousands of companies. Target allocation percentages provide your destination. Companies with under $250,000 in real revenue should target 5% profit, 50% owner compensation, 15% taxes, and 30% operating expenses. These percentages shift as businesses grow. Companies exceeding $1 million can sustain 10% profit allocations while reducing owner compensation percentages as fixed salaries become smaller portions of larger revenue streams. The transition requires patience and incremental progress. Attempting immediate jumps from current to target percentages destroys businesses. Instead, quarterly adjustments of 1% increases to profit, owner compensation, and taxes, while reducing operating expenses by 3%, create manageable change. A company currently allocating 2% to profit increases to 3% next quarter, then 4%, gradually reaching the 5% target over 6 quarters. This gradual approach forces operational efficiency. When operating expenses decrease from 85% to 82% of real revenue, businesses identify unnecessary subscriptions, renegotiate vendor contracts, and eliminate waste. The constraint creates innovation. Companies report discovering cost-cutting opportunities they never noticed when money flowed freely through single accounts without boundaries or measurement. Part 3. The Rhythm of Profit. Biweekly Fund Distribution. The magic happens when chaos becomes rhythm, and nowhere is this more apparent than in the biweekly distribution schedule. Picture 2 specific dates circled on every successful entrepreneur's calendar, the 10th and 25th of each month. These aren't arbitrary dates. They represent payday for your business's financial health. On these precise days, 3 non-negotiable activities occur that separate profitable companies from those constantly scrambling for cash. First comes the fund distribution ceremony. Money sitting in your income account gets divided according to your predetermined percentages. If your current allocation calls for 3% to profit, 8% to taxes, 20% to owner compensation, and 69% to operating expenses, these transfers happen religiously every 2 weeks. No exceptions. No "we'll catch up next time" excuses. Amazon's Jeff Bezos famously maintained this type of discipline in the early days, making regular transfers to separate buckets even when cash was tight. The predictability created clarity about what money could actually be spent versus what belonged to other purposes. Second comes bill payment from the operating expenses account only. This eliminates the dangerous game of mixing operational costs with profit or owner compensation funds. When the OPEX account runs low, it signals operational efficiency problems rather than overall business failure. Third involves a quick financial health assessment. How much accumulated in each account? Are the percentages working? Does anything need adjustment? This bi-weekly check-in prevents the all-too-common scenario where entrepreneurs wake up at year-end wondering where all the money went. The psychological impact proves remarkable. Seeing money flow into profit, owner comp, and tax accounts twice monthly creates momentum. Each transfer becomes visible evidence that the business generates real wealth, not just revenue that disappears into operational black holes. Companies using this rhythm report dramatic mindset shifts. Financial management transforms from a monthly panic session into a predictable routine. Cash position becomes immediately clear every 14 days instead of remaining mysterious until crisis hits. The frequency matters more than the amounts. Small, consistent transfers build powerful habits and clear awareness. A restaurant owner in Michigan discovered that bi-weekly distributions revealed seasonal cash flow patterns invisible during monthly reviews, allowing better planning for slow periods. This schedule creates what behavioral economists call implementation intentions, specific plans that remove decision-making from emotional moments. When cash is tight, the schedule continues. When cash is abundant, the schedule prevents overspending. The rhythm becomes your financial compass, providing direction regardless of emotional weather. Part 4. Hidden Accounts and the No Temptation Strategy. The bi-weekly rhythm creates momentum, but temptation remains your biggest enemy when profit and tax money sits visible in your main accounts. Think about your kitchen. You know exactly where the cookie jar sits. Every time you walk past, your brain calculates how easy it would be to grab just one. The same thing happens with business money. When your profit and tax funds remain visible in accounts you check daily, your mind starts justifying why you need that money for urgent expenses. Michalowicz discovered this firsthand when he kept dipping into his profit account for equipment purchases that felt essential. Each time, he promised himself it was temporary. Each time, the money disappeared permanently. The solution required removing the temptation entirely. This is where hidden accounts change everything. You need 2 additional savings accounts at completely different banks from your main business accounts. The first is Profit Hold, where you transfer accumulated profits every quarter. The second is Tax Hold, where tax money goes to stay safe from impulsive business decisions. Here's the critical part. You must set up these accounts without online access. No mobile apps, no web login, no balance checking from your phone. The inconvenience is intentional. When you want to see your balance, you have to drive to the bank or call during business hours and speak to a human being. Amy, who runs a graphic design studio in Portland, thought this seemed extreme until she tried it. Within 3 months, she stopped thinking about the money in those accounts. The mental effort required to access them made casual spending impossible. When real emergencies arose, the inconvenience forced her to pause and consider whether the expense was truly necessary. The system works through automatic transfers. On each bi-weekly distribution day, money flows from your main profit and tax accounts into these hidden accounts. You see the transfer happen, but then the money disappears from your daily view. This represents what behavioral economists call choice architecture. You're not relying on willpower to avoid temptation. You're designing a system that makes good behavior automatic and bad behavior difficult. The friction between you and your money becomes your protection. Banks make this surprisingly easy. Most offer automatic transfer services that move predetermined amounts on specific dates. Set it up once, and the system runs without your involvement. Your profit grows invisibly while you focus on running your business instead of managing temptation. Chapter 3. Implementation. Making Profit First Work. Part 1. The Instant Assessment. Diagnosing your business health. The moment you calculate your current allocation percentages against target allocation percentages, the truth about your business finances becomes impossible to ignore. Think of the instant assessment as your financial blood test. Just like a doctor compares your cholesterol numbers to healthy ranges, this diagnostic compares where your money actually goes versus where it should go. Most business owners discover they've been financially bleeding without realizing it. The math is brutally simple. Take your total revenue from the past 12 months. Calculate what percentage went to profit, owner compensation, taxes, and operating expenses. Then compare these percentages to Michalowicz's targets for businesses your size. The gap between current and target numbers tells the whole story. Sarah, owner of a marketing agency, thought her business was healthy because revenue hit $500,000 annually. Her instant assessment revealed operating expenses consumed 85% of revenue, while target should be 60%. Profit was zero instead of the target 15%. She was working harder each year while getting poorer. The assessment typically exposes operating expenses running 15 to 30 percentage points above target. Meanwhile, profit and owner compensation often register zero or dangerously low. This pattern explains why so many business owners feel trapped despite growing sales. The beauty lies in what happens next. Write increase or decrease next to each category based on your gaps. If operating expenses need to drop from 85% to 60%, write decrease 25%. If profit needs to jump from 0% to 15%, write increase 15%. These numbers become your roadmap. Smart business owners resist making dramatic cuts overnight. Instead, aim for 1 to 3% quarterly improvements. If operating expenses are 30% over target, reduce them 2% each quarter for 3 years, rather than slashing 30% immediately and destroying operations. Companies using this gradual approach successfully reach target allocations without the chaos of massive layoffs or service disruptions. The assessment creates accountability because the numbers don't lie. But the incremental changes make success achievable rather than overwhelming. This diagnostic ends the dangerous habit of measuring success solely through revenue growth while ignoring profit hemorrhaging. Part 2. Cutting expenses without killing your business. When most business owners hear cut expenses, they panic and start slashing everything indiscriminately. This approach kills businesses faster than high costs ever could. The smartest entrepreneurs treat expense reduction like a puzzle game instead of a punishment. Think about your business like a race car. You wouldn't remove the engine to make it lighter. You'd find ways to make every component work better while weighing less. Netflix proved this concept when they transitioned from DVD shipping to streaming. They didn't just cut costs randomly. They reimagined their entire delivery system, reducing expenses while improving customer experience dramatically. Your biggest expense category is probably labor, and this requires surgical precision rather than a chainsaw approach. Amazon's Jeff Bezos developed a simple framework for evaluating team members. First, identify who brings in more money than they cost. Second, determine which roles absolutely must stay in-house. Third, consider which tasks you could temporarily handle yourself. Finally, eliminate positions that fail all 3 tests. Ford Motor Company used this exact approach during their 2008 restructuring. Instead of massive layoffs, they evaluated each role's contribution to profitability. Many managers discovered they could handle additional responsibilities temporarily while maintaining quality standards. The hidden money drain comes from automatic payments you've forgotten about. Cancel every automatic withdrawal immediately. Request new credit card numbers from your bank. This forces every recurring charge to surface when vendors call about failed payments. You'll be shocked at what you find. Shopify's early team discovered they were spending $3,000 monthly on software subscriptions they'd forgotten about. By forcing everything to restart manually, they identified actual necessities versus convenience purchases that had become expensive habits. For remaining essential expenses, demand 25% reductions. Most vendors would rather discount than lose customers entirely. When Airbnb faced early cash flow problems, they renegotiated office rent, insurance rates, and service contracts. Their landlord accepted 30% less rather than find new tenants during uncertain economic times. The goal isn't deprivation, it's innovation. Constraints force creativity that abundance never could. Southwest Airlines built their entire business model around this principle, proving that limitations often produce breakthrough solutions rather than mediocre compromises. Part 3. The Debt Snowball Method for Business. The hardest part of implementing Profit First isn't learning the system, it's dealing with the mountain of debt that makes every percentage allocation feel impossible. Most business owners treat debt like background noise. They make minimum payments, add new credit lines when cash gets tight, and hope growth will eventually solve everything. This approach creates a financial quicksand where every dollar earned gets immediately sucked away by obligations. Netflix nearly collapsed in 2011 because they kept adding debt to fund expansion while ignoring their existing obligations. Only after implementing a strict debt elimination strategy could they properly allocate profits. Before touching your allocation percentages, you must freeze all debt immediately. Cancel recurring payments on anything non-essential. That monthly software subscription you forgot about? Gone. The equipment lease for machinery you rarely use? Negotiate an exit. The goal is reducing your monthly fixed costs 10% below what your instant assessment suggested. This creates breathing room where Profit First can actually function. Dave Ramsey's Debt Snowball method works brilliantly for businesses. List every debt from smallest to largest, ignoring interest rates completely. Pay minimums on everything except the smallest debt, which gets every available dollar. When that first debt disappears, roll its entire payment into the second smallest debt. The psychological momentum from eliminating debts quickly outweighs the mathematical advantage of attacking high-interest debts first. Real estate investor Brandon Turner used this exact approach when his rental properties were drowning in debt. Instead of focusing on his largest mortgage, he eliminated 3 small equipment loans totaling $12,000 in 8 months. The confidence boost from those quick wins gave him motivation to tackle bigger obligations systematically. Your quarterly targets should be realistic but aggressive. Increase profit allocation 3%. Decrease operating expenses 5%. Increase owner salary 2%. Most importantly, commit to 0 new debt. No exceptions. No emergency credit lines. No equipment financing deals that seem too good to pass up. The snowball effect becomes addictive once it starts working. Each eliminated debt frees up monthly cash flow that accelerates the next payoff. Chicago restaurant owner Maria Santos eliminated $17,000 in credit card debt using this method over 14 months. The freed-up monthly payments allowed her to properly fund her profit account for the first time in 5 years of operation. This isn't just debt reduction. It's creating the financial foundation where profit allocation becomes possible rather than theoretical. Part 4. Finding hidden money through radical efficiency. Most business owners work incredibly hard, yet wonder where all their money goes. The answer lies buried in the daily operations you've grown accustomed to running. Your business likely has thousands of dollars hiding in plain sight. These aren't accounting tricks or complex financial maneuvers. This money sits trapped in processes that waste time, products that barely break even, and clients who demand extensive effort for minimal return. Take Jacksonville plumber Tom Rodriguez. He discovered that emergency weekend calls generated 40% higher revenue per hour than routine weekday maintenance. Instead of taking every job that came his way, he shifted focus to emergency services and raised his weekend rates 25%. His revenue stayed flat, but his profit doubled because he worked fewer hours on higher margin work. The key difference between struggling businesses and profitable ones isn't working harder. It's working systematically. Most owners rely on individual heroics, staying late, handling difficult customers personally, or pushing through complex projects that drain resources. This approach creates businesses that depend entirely on the owner's constant presence and energy. Systems change everything. Document what works, then teach others to replicate it. When Sacramento marketing consultant Jennifer Park systematized her client onboarding process, she reduced new project setup time from 6 hours to 90 minutes. This freed up 20 hours weekly that she redirected to high-value strategy work, allowing her to raise rates 30% while delivering better results. Becoming exceptional at your core competency matters more than being decent at everything. Customers pay premium prices to experts, not generalists. Phoenix auto repair shop owner David Kim stopped offering basic oil changes and focused exclusively on transmission repair. His shop became the go-to destination for transmission problems throughout the metro area. He doubled his hourly rate because customers viewed him as the leading specialist. Once your profit account covers 3 months of fixed expenses, strategic reinvestment becomes possible. This creates a powerful cycle where profit funds improvements that generate more profit. Kim used his profit reserves to purchase specialized diagnostic equipment that reduced troubleshooting time by 40%, allowing him to handle more complex cases daily. Efficiency investments compound over time. The diagnostic equipment paid for itself within 8 months through increased capacity and higher quality repairs. This additional profit funded advanced technician training, further cementing the shop's reputation as the transmission specialist in Phoenix. This systematic approach transforms profit from an occasional bonus into the fuel that drives continuous business improvement. Chapter 4: Mastery, Advanced Techniques and Lifestyle Integration. Part 1: Duplicating your best clients using the 80-20 rule. Most business owners chase new customers while their best clients sit right under their noses, generating the bulk of their profits. The numbers tell a startling story. When Amy Porterfield analyzed her online course business, she discovered that just 20% of her customers generated 80% of her revenue. More shocking was the flip side. 20% of her clients consumed nearly 70% of her support time while contributing minimal profit. This pattern repeats across industries. Restaurant chain Sweetgreen found that their top 20% of menu items drove 80% of sales, while the bottom performers required extensive prep time and inventory management. The Italian economist Vilfredo Pareto first observed this phenomenon in 1896, noticing that 80% of Italy's land was owned by 20% of the population. Your business likely follows this same distribution. Some clients pay invoices within days, rarely complain, implement your recommendations, and send referrals. Others demand constant attention, negotiate every fee, pay late, and question your expertise. The difference isn't just convenience, it's profit. Mike Sinise, a marketing consultant from Chicago, transformed his agency after identifying his ideal client profile. His best customers shared specific traits. They paid within 30 days, trusted his recommendations without micromanaging, and referred at least 2 new clients annually. Most importantly, these relationships generated 60% higher margins because they required minimal revision cycles. The first step involves honest client evaluation. Calculate each client's true profitability by factoring time investment, not just revenue. Sarah Peterson, who runs a graphic design firm, discovered that her highest revenue client actually cost her money when she tracked phone calls, revision requests, and emergency projects. Firing problematic clients feels scary, but creates immediate relief. Peterson terminated her most demanding client and found herself with 20 hours per week to serve better customers. Within 6 months, she'd replaced that revenue with 2 ideal clients who generated higher profits with half the stress. Duplication becomes systematic once you understand your ideal client profile. The most profitable path involves encouraging your best clients to purchase more frequently or upgrade services. Netflix mastered this by analyzing viewing patterns and recommending content that increased engagement. The second strategy focuses on converting mediocre clients into better ones by guiding them toward your most profitable offerings. Peterson now steers logo design clients toward full branding packages, which generate 3 times the profit margin. The final approach involves actively seeking prospects who match your best clients' characteristics. This means marketing to specific industries, company sizes, or behavioral patterns, rather than casting wide nets, hoping for any customer. Part 2. Advanced Techniques, Accountability, and Profit Pods. When business owners implement Profit First alone, 90% abandon the system within 6 months. The difference between success and failure often comes down to one simple factor: accountability. Michalowicz discovered this pattern after tracking hundreds of businesses attempting the Profit First method. Those who shared their progress with others maintained the system at dramatically higher rates. Reed Hastings applied similar thinking when building Netflix's corporate culture around transparency and peer feedback. The company requires executives to share performance metrics with colleagues regularly, creating natural pressure to maintain standards. Accountability groups form the foundation of sustained profit-first success. These consist of 3 to 5 business owners who meet monthly to report their numbers, share challenges, and celebrate wins. The format stays simple. Each member presents their profit percentages, discusses what worked or failed, and commits to specific actions before the next meeting. Tom Patterson runs a manufacturing company in Ohio that struggled with cash flow for years. After joining an accountability group, his monthly profit allocation jumped from 0 to 12% within 8 months. The knowledge that he would face his peers empty-handed forced him to prioritize profit transfers even during tight periods. Profit pods take accountability deeper through teaching dynamics. Business owners form small groups where each person teaches profit-first principles to others, while receiving hands-on implementation support. This approach leverages a fundamental learning principle. People retain 90% of what they teach versus 10% of what they hear. Consider how medical residents learn surgery. They don't just observe procedures, they explain techniques to junior students, while senior doctors guide them. This teaching requirement forces deeper understanding than passive observation alone. Similarly, Profit Pod members must articulate concepts clearly enough for others to implement them, which strengthens their own mastery. Sarah Chen joined a Profit Pod after her consulting firm plateaued at break-even performance. Through teaching cash flow management to other members, she identified gaps in her own system. Within 6 months, her firm achieved consistent 15% profit margins, while helping 3 other businesses implement successful systems. These groups also establish crucial business health benchmarks. Companies should generate between $150,000 and $250,000 in revenue per full-time employee. This metric provides immediate diagnostic capability for identifying overstaffing or productivity issues. A software company generating only $75,000 per employee likely has too many staff members or insufficient revenue per customer. A consulting firm hitting $400,000 per employee might be overworking their team or undercharging for services. This benchmark cuts through complex financial analysis to reveal fundamental operational health instantly. Part 3. The Profit First Life, Personal Finance Application. What if managing your personal money worked exactly like running a profitable business? The same principles that transform struggling companies into cash-generating machines apply directly to your household finances. The 5 core rules for personal profit-first living work like guardrails against impulse spending. Always look for free options first. Libraries offer books, Parks provide entertainment, and community events replace expensive outings. Reed Hastings famously started Netflix after being charged a $40 late fee at Blockbuster. Free alternatives often spark the biggest innovations. Never buy new when used works equally well. A 3-year-old Toyota Camry performs the same transportation function as a brand new model while costing thousands less. Warren Buffett still drives his 2014 Cadillac XTS, proving that practical transportation beats status symbols every time. Never pay full price if avoidable. Everything goes on sale eventually. Apps like Honey automatically find coupon codes, while cashback credit cards return money on purchases you were making anyway. The key is patience. Retailers depend on urgency to drive full-price purchases. Negotiate and seek alternatives before every purchase. Cable companies routinely offer retention discounts when customers threaten to cancel. Insurance rates drop when you shop competitors annually. Even medical bills become negotiable when you ask about payment plans or cash discounts. Delay major purchases until you list 10 alternatives and think through each option completely. This cooling-off period eliminates emotional buying while revealing creative solutions. Maybe you need transportation, not necessarily a car. Ride-sharing, public transit, or even relocation near work might cost less than car ownership. The wedge concept prevents lifestyle inflation from stealing your wealth. When income increases, save at least half the raise before lifestyle creeps upward. A $10,000 raise means $5,000 goes directly to savings, while the other $5,000 gradually improves your quality of life. This approach builds substantial wealth while still allowing lifestyle improvements. Software engineer Sarah Chen saves 60% of her annual promotions over 5 years, accumulating enough wealth to buy a house while still enjoying modest upgrades like better groceries and occasional vacations. Reserve significant discretionary spending for quarterly profit-first dividends. Instead of constant small indulgences, concentrate fund money into quarterly celebrations funded by actual business profit. This creates sustainable psychology, balancing delayed gratification with regular rewards, making the system feel generous rather than restrictive. Part 4. Teaching the next generation financial discipline. The most powerful financial lesson you can give your children costs nothing, but changes everything about their future relationship with money. Teaching kids profit-first principles requires something far more effective than lectures about saving money. Children learn through concrete action, not abstract concepts. The 5-envelope system transforms every dollar they receive into a hands-on financial education that builds instincts most adults never develop. When 8-year-old Emma receives her $10 weekly allowance, she immediately divides it across 5 labeled envelopes. $2.50 goes into her big dream envelope, currently funding a bicycle she wants next summer. $1 goes to family support, where she contributes to household expenses like groceries or utilities. She chooses the amount, but contribution remains mandatory. $1 enters her impact envelope for charitable giving or small business ideas like her neighborhood dog walking service. The vault receives $1 as her emergency fund, money she hopes never to touch. The remaining $4.50 becomes mad money for immediate spending on candy, toys, or movies with friends. This system teaches profound lessons most children never experience. Emma learns money serves multiple purposes simultaneously. Unlike friends who spend allowances immediately, she experiences the satisfaction of watching her big dream fund grow week by week. When her bicycle fund reaches its goal after 8 months, she understands delayed gratification creates possibilities immediate spending cannot. The family support envelope teaches responsibility beyond personal wants. Emma discovers she contributes to her family's well-being, creating ownership in household success. Her 10-year-old brother Jake contributes his family support money toward internet bills. Understanding his gaming depends partly on his contribution. Impact money introduces generosity and entrepreneurship early. Emma donated $20 to animal rescue last year, while Jake used his impact fund to buy supplies for friendship bracelets he sells to neighbors. Both children learn money can help others and create opportunities. The vault builds security thinking most adults lack. Emma knows unexpected expenses happen, and her emergency fund provides safety. This creates natural profit-first psychology, where money automatically flows to multiple purposes before consumption. Children using this system develop fundamentally different money relationships than peers. They naturally think about allocation before spending, understand contribution obligations, and experience the compound satisfaction of long-term goals. These concrete habits create adults who instinctively implement profit-first principles because the concepts feel normal rather than restrictive. Financial discipline becomes second nature when learned through consistent practice rather than crisis intervention during adulthood.